Hello traders, Gary Wagner here just after 10 o'clock in Honolulu, 4 o'clock in New York. Markets have just closed. It is Thursday, 6th day of August 2015, and this is the daily report for gold and silver. We do have the equities markets trading lower after 6 days in a row. We do have gold continuing to be range bound. Now, it is up slightly on the day, up about $3 when we look at COMEX at 88.50. We've seen it trade as high as 93.30 and as low as 82.70 on the day. When we look, of course, at our Forex, that is still trading up around $4.50, 89.18, low 83, high 94 on the day. So traders, as far as silver goes, it is currently trading up 5-6 cents on the day. When we look at COMEX, that closed at $14.60, 60.5 cents. It's seen a low of $14.49 and a high of 73 on the day. Of course, spot silver is still trading. It's currently, call it 64, and highs and lows are roughly the same on the day. Now, traders, of course, the reason that the market obviously has been so flat has been a lack of fundamental data, and most importantly, the fact that everyone seems to be awaiting that jobs report, which is due out tomorrow. And whether or not it comes in at expectation, above expectation, or below expectation will really determine a consensus or a sense for whether or not the Fed is still on track to begin rate hikes as early as September. Now, we've always been a proponent of saying it's not so much when, or not so much if, but when. And it seems as though that when is scheduled for September. Of course, we'll have to see what the market brings us tomorrow, and especially what kind of jobs report we get. Now, when we take a look at the most recent activity, and look at this, you're looking at July 21st, so, roughly 2 weeks ago, we can see that this market undoubtedly has been trapped in this defined range. But even with this range, we do have a series of, except for a couple of occasions, actually only one here where you've got this dramatic high and dramatic low on the day compared to the body, but you do have the market having a ascending trend and a bias to the downside. There can be no doubt about that. Now, we do have the market, as I said, trading up a couple of dollars, but it has been unable to break the ceiling at 1100. It has been unable to break the floor, call it at 1080. So we have some defined support here at 1080. And even when we look at the recent activity and when we remove the highs and the lows, meaning just look at the real bodies, you can see that over these last couple of days, the range between the open and close has dramatically compressed. We're not even seeing days of an open to close of $5 or $6 or $8 consistently over time, and we are also getting that alternating candle color. Of course, what that tells us is that you've got a market in consolidation. You have a market that has not yet made a determination as to what side it wants to trade on, whether we're going to see this market break to the downside or break to the upside is really, I believe, data dependent, and that data is just a day away. The other market observations that we have been talking about over this last week, actually for the last couple of weeks, is that there are conflicting ways to look at the market in terms of technical studies. When we look at the big picture, and of course we've looked at this chart on quite a few occasions, we've talked about the fact that we had a genuine break below that 61% retracement level. That's at 1156, and that to me is absolutely a fundamentally important piece of data in terms of technical analysis, is this hard break. At the same time, when we look, and we're only at the beginning of the month, but you can see we're trading a little bit lower. That's slightly red, but there's almost zero range as we look at that market. And that, of course, traders, really lends itself on a technical basis to a real distinct possibility that we could see this market head lower. Now, there's also some interesting technical data out there and studies that show us that we could be looking at a potential bottom. And in that, I'm talking about our current Elliott wave count. Let's go ahead and pull one of those charts up. So traders, I've done just that. We are looking at a weekly chart with our current Elliott wave count. And if you recall, our basic projection as this market was trending lower, we're on record also with our chart this series, but we were looking for the market to genuinely go to around 1080. We've absolutely hit those numbers and then some. And when we look at our current Elliott wave count, we have our long wave 3, our wave 4, and this extended wave 5. The projections in terms of a systematic approach could be in this area as low as about, call it 1050, a little bit below 1050. And as you know, we said on a number of occasions, including yesterday, that if we get a solid break to the downside in terms of the numbers we're looking at, it would be approximately 1050, 1035 on the low side. And we base that on a couple of Fibonacci studies as well as this Elliott wave analysis. So are we looking at some sort of potential bottom? Well, to be quite honest with you, we have had no technical confirmation that any such move is here. But here's the caveat to that. Typically, as a market is trending lower and it pivots, there are discerning factors, or not so much factors, but there's discerning signals that we've actually reached a pivot point. For example, right in this area that I've just highlighted, you can see we've had engulfing bearish, then you get your confirming candle. Market absolutely moves lower, and you can see this 3-candle pivot here is really a very, very close match to a 3-river morning star, and that's why I would label this particular 3-day move here, or 3-week move. We're looking at a weekly chart, but I would label this as a 3-river morning star variation. Now, when we take that and then compare it to our most recent activity, well, yes, we do have our red candle. We've had a defined downtrend. That's first criteria. We've had our red candle. We do have our small bodied candle. That's last week's activity, but we've got another small bodied candle this week. So we haven't had any kind of pivot or recovery. And so without seeing that pivot, we're not going to be able to, on a technical basis, really ascertain that we've hit any kind of bottom action and are moving higher. Now, that is one of the shortfalls, of course, to technical analysis. A technical analysis is always looking at historical data and from there attempting to extrapolate where we think it's going. We cannot make any kind of a concrete call until that market move is pivoted. In other words, it's been in a defined downtrend, you got some sort of consolidating candle or area, and then you see the market move back up. We're absolutely not seeing that, and the overall characteristics over the last 2 weeks has been absolute consolidation in the market. So on a technical basis, we wouldn't be able to ascertain with any kind of certainty that we've hit a bottom and the market's moving back up until at least it hit a bottom and formed that V, because it's really that V that tells us that. In other words, this down move and then at least the beginning of an up move, that's the pivot, that's the V that us as technicians look for on the bottom. And quite honestly, we haven't seen anything like that. If anything, we've seen the market drift lower and consolidate. Now, the fact is this is going to be a data-driven move. In other words, that jobs report is really going to be an important indicator of whether or not there is the belief that the Fed is on track to begin rate hikes. And based upon how that report comes out, I think genuinely will send waves into the market one way or the other once those numbers are released. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow, day of the jobs report and weekly update review for the weekend. Bye-bye.